Hey, it's V. Lee here. So today we are chatting with Steve Sorensen, a very daring real estate rookie who buys property remotely. So get ready to learn and be inspired, and maybe you'll be motivated enough to go out and buy a property or two by the end of this interview. So let's hear it for lesson learned from a rookie real estate investor. So we got Steve here with us. Steve, why don't you give the audience a quick introduction?
I'm Steve Sorensen. I work for as an engineer for a renewable energy company, and I am in the process of making the transition to real estate full time. I got 4 properties currently. I have a triplex in Minnesota, which is where I'm from, that I bought on an FHA, and then I own my primary residence here in Denver now. And then I recently purchased 2 properties in the Houston area, which is how you and I met.
So I met you and you got a very interesting approach to what you do. Now, you live in Colorado, right? But you buy property from all over the place. So tell us about that. How did that happen and why did you choose that route?
When I bought my first property, I was living in North Dakota on wind farms, and I was pretty, I'd say, overworked and just trying to figure out a way that I could make some passive money for the long term, because I didn't want to do that for the rest of my life. And I have an engineering degree, and I was kind of out in the field just kind of miserable, and I saw a lot of people I knew that had, I guess, different degrees that I didn't. I guess I was working a lot harder than a lot of them, I'll say, and not as happy as a lot of them were. So I was, what can I do? Make some passive income. I think I can buy a property, and so I did. And I went to the market that I knew. My parents were still there. I had some connections there, and was able to find a property semi-remote. I was kind of close enough. I came back over during a break to check out the property and ended up working. That was 3 years ago, as of I think January 31st. So I closed January 31st, 2020. And it was technically my primary residence. I was on the road a lot, so ended up renting out one of the rooms within my unit in that triplex. And then I got a new position within my company after I was all, a year after that or so. And wanted a house hack, so I bought a bed. I wanted to get out to Denver. I just wanted to be in the mountains. So I bought my primary residence, turned the basement into an apartment, which is where I am now. And I rent out the upstairs 2 units. I Airbnb it for month-long stays, which has been my most profitable property so far. And
the one in Colorado.
Yeah, I keep it booked pretty much all the time. It's month-long rentals. It's families. They do a great job of taking care of the place, and really have had minimal issues with it at really good prices. So, and then there's a whole long story with my triplex that was cost me a lot of money during COVID. I bought it. I mean, if you remember when COVID hit, it was about a month before that I closed. So, had a whole set of issues there. But since then, that one started to be pretty profitable now too. And then I knew I didn't want to keep investing in the Denver area because my capital wasn't going to be enough to get me anything decent because it's such an overpriced market. So I started looking around, did some market research analysis, and one thing led to another as far as having some connections in Houston. Houston looked like a good market. Ended up in the Texas City area doing the BRRRR strategy on 2 houses, and one of them I'm operating as an Airbnb, and then the other one I'm operating as a long-term rental.
So you live in Colorado, but you were brave enough to buy property in Texas. Did you ever come and see these property before you closed on them?
No, I didn't. They were relatively cheap. I got them each at about $100,000 from a wholesaler, so they were obviously going to need work. I made some connections with contractors down there. Again, I hadn't met them, but I went ahead and vetted them out as best I could. And then just went ahead and took the risk. But I had them go down and look at the properties, send me photos, and my agent also did the wholesaler also gave me some reviews and all that. So I had the 2 sets of eyes on it. Came up with a budget, ran the numbers, and at that point just kind of took a little bit of a leap of faith and definitely learned some lessons. It was far from perfect, that's for sure. But I think and this was just this last year, so I'm still getting kind of into the operation phase. So still learning a lot and still getting things figured out, but we're kind of getting to the point where things are moving along by themselves.
Well, you're a lot braver than I am. I bought over 250 houses, and I tell you, I probably did not see a handful of them only. So
Yeah, and I mean, in an ideal world, I would, but I'm still working my W-2, and it's either do nothing, don't see him and do nothing, or take a risk and don't see him. But also, but.
So you said you realized you made some mistakes. Share that so that people can learn from your mistake as well.
Yeah, so one big one that I just came up last week, and I was listening to your last episode with Steve, I forget his last name, but he was talking about due diligence.
Yeah.
Definitely some good good lessons there. The one that came up was the air conditioning unit. I had not put enough attention to the air conditioner system, the AC unit, and come to find out needed a full replacement. The thing was completely shot. All the wiring was bad, and so that was about a $14,000 bill that I needed to get done in a couple days because I had a renter in there. So definitely going to be at the top of my list going forward as far as as due diligence. Something that my contractor didn't look at when he was on site, unfortunately, and so that's a big cost to build into my rehab budget.
I think buying remotely sounds like a really wonderful idea, right? But to me, the challenge is still like, how can you see, like, you can't see if a house needs foundation repair from picture unless it's really crooked, right? Otherwise, you can't see. And then you can't see a lot of things unless you know specifically to go look for those things.
Right. Yeah, I agree. I mean, I think a lot of it's building relationships. The contractor that went the first time was not the contractor that finished the job. He quit on me about halfway through, and he connected me with somebody else. It wasn't a complete disaster, but going forward, I'll have a relationship with this contractor now that I think is going to go a lot better. So, I agreed. Coming up with a nice checklist going forward for my contractor, say, hey, these are things we need to check, and then eventually, when I quit my W-2, which is hopefully sooner rather than later, and I get into this full time, I'll have the flexibility to go check places out on my myself before I buy them. In the meantime, my strategy, right or wrong, is going to have to be go sight unseen and just rely on the relationships I build with people out in these places.
You own what, four different locations, right?
Correct. Yep.
And two of them you've seen before you buy, and the two down here in Texas that you didn't see.
Correct.
Did you do good on them?
So the first one, yes, the first one is the one that's Airbnb, and that one's pretty steady. And I'll say they both have gone pretty well. The rehab on the second one was about double the budget that my contractor gave me, and there really was wasn't really any good reason for it. There wasn't anything specifically unseen that couldn't have been identified during his walkthrough, so it was really just a bad number that he gave me. That being said, with the BRRRR, the idea is to get all of my cash back out at the end, and so I think I left about $15,000 in there. So I would have preferred to have that back in my pocket, but at the end of the day, getting a property for $15,000 that's going to make me money in the long run is an okay investment, right?
So just for the audience, BRRRR is buy, rehab, refinance, right?
Yep.
Did I get the order right? Okay.
Yep.
The young people nowadays, they get creative with all these terminologies.
Yep.
They're trying to keep up. Yeah, you're right. Like, you can't, in my opinion, you can't go wrong with real estate if you keep holding, right? And different people say it different way. Rent your way out of trouble, or if you end up paying too much for a property, you just rent it out and have your tenants to pay down your mortgage, and eventually you'll be whole again, right? So if you were to look back on these two properties that you bought remotely and the process of all of it, what would you have done differently?
This episode is brought to you by Buzz Vacation Rentals, a premier property management company in Houston and Galveston. Give Buzz a call today if you need help in managing your short-term and vacation rental properties at 281-549-8432 or visit their website at pm.buzzvacationrentals.com. Now back to the Real Estate Baller Show.
So I probably would have identified better properties. That being said, I wanted to go to kind of a low risk price range, and like I said, $100,000. I couldn't get myself in too much trouble. I had the capital to to cover anything aside from a complete disaster. But I think I rushed it a little bit. So I think taking my time, being a little bit more picky on properties, would definitely be the first thing. And then refining a list, basically, like I said, for my contractor to look at, say how much, check these things out, instead of just saying, I think I relied on his expertise a little bit too much, but he's not an investor. He doesn't, he's not holding the checkbook. So although I think he gave me what he thought was an honest number, I don't think it was as thorough as probably should have been. And so I think really, defining what he should be looking for and putting that into like a checklist form would be the next one.
So he walked through, but he was missing things.
Yep.
Not that he inflated things.
Yes. Yeah. Exactly.
Okay.
Yep.
Okay.
Yep.
Well, at least you have that working for you, right? He didn't inflate things and add things.
Right. Yeah. And I think he was an honest guy and all that. I don't question any of that. But he was just, like you said, he missed things. He didn't look for in all the nooks and crannies that he should have, and the budget just kind of kept going up.
You're luckier than some other investor who got contractor that inflate the price and miss things and don't do the work right?
Agreed. It could have been worse.
Yes. Okay. So even all of that happened. How long did it take you to manage the projects from the time you bought the property until the time you put a tenant in it?
Let's see. I bought in, I think, February last year. So it was about 4 to 6. I think the second one was about 6 months by the time I got a long-term renter in there. And that was the second property where the budget went way over, and there was a lot of add-ons that kept kind of, again, taking time, taking up money. The first one was quite a bit quicker. That was probably closer to 4 months.
Being far away, how were you able to do quality control on these projects?
So I did go down during the rehabs a couple of times because that's a little bit more flexible. I can do it on my schedule a little bit more than in the middle of a bid process. And then I just basically made sure that he was sending me pictures at the end of every week, thorough pictures of all the work that he had done, and kind of itemize what things he had done. And then, those trips down, trying to do the best I could from that perspective. And it worked pretty well. Can't really think of anything that was true, just quality mistakes. There's a few things that were missed, which I guess would kind of qualify as quality, but mostly just things that were semi-unforeseen that have popped up since, and some more cost. But I mean, I think that's fairly typical also. When you rehab something, a few things are going to come up here and there, and you just kind of nip them in the bud as they come up.
Yes. That's the thing with buying a fixer-upper, right? You never know.
Mm-hmm. Yeah, exactly. I mean, unless you scrape it and start over, you're putting Band-Aids over a couple of things, whether you want to or not, and some things are just going to pop up after the fact. So just dealing with it as they come up.
Because I know, like I said, a lot of things could be missed through pictures and videos. It's nothing beats seeing things with your own eyes, right? Did you have any rehab or real estate experience prior to buying these properties? No,
none really. I mean, my background in general, I think, kind of lent itself to being semi-prepared, but I mean, it's still the basics. Obviously, everybody, there's a lot that I'm still learning. I mean, a ton that I'm still learning. But the basics of getting things done is not rocket science. And I mean, I've worked in plenty of construction fields. I've worked on the commercial side of engineering companies, manufacturing companies, things like that. And then we were kind of a do-it-ourself type family. So I had, turned a lot of wrenches, pounded a lot of nails in at my parents' house, things like that, which, doesn't make me an expert, but I've been exposed to a lot of it. So that all together, I figured, it's enough to get started. And then, as long as you can build relationships with people. I mean, I'm not going back to my triplex in Minnesota and fixing anything. You know, I have people that do that for me. I have a handyman and a property manager there that manage all that stuff. So just putting the right pieces in place and knowing how to manage all that stuff, budgets, contracts, people, all that stuff is really the most important part.
Well, that's awesome. You know, sound like you didn't have the best experience, but you didn't have the worst experience either. But that still didn't chase you away from real estate. Didn't you tell me you were going to make a big life decision? If you enjoyed this episode so far, do hit that like and subscribe button now so that we can keep giving you tips on real estate investing.
Yeah, exactly. So, I mean, the first point is not chasing me away. I'm actively pursuing more properties. And I was listening to an article the other day that was saying, you know, it'd be silly to quit after you paid the tuition. You know, this is me paying my tuition, kind of paying the basics, learning the basics here, making some mistakes. And if I gave it up now, then that money would really be wasted. So yes, I'm actively pursuing leaving my W-2 as soon as I can, and have somewhat replaced my income. My plan is to basically, I think I'm going to get one more property here before I leave, and then take on handyman work as supplemental income so that I can go about 50-50 on probably handyman work and pursuing real estate, and then I'll have a lot more flexibility to really spend time pursuing real estate, which, you know, right now I'm at that stage where I'm trying to leave and I'm working my 40, 50, 60 hours at my W-2, and then in the evenings and weekends, chasing my next property, working on my existing properties, all that type of stuff. So long days right now, which, you know, is fine. It's part of the deal, but hoping to make that transition here soon where I can put more of my energy into pursuing just the real estate side.
Well, I want to congratulate you, Steve, for making that decision to get into real estate, because I think there's nothing that beat real estate, you know, out there, the upside of what we get for owning properties and holding rentals.
Yeah, thanks. I mean, it's very exciting. It's the most exciting parts of my day when I make some progress and I can see light at the end of the tunnel. I mean, it's cool owning my own things. Like I said, I kind of come from a blue collar family that, you know, you just go to your W-2, your 9 to 5, and you come home and they pay you what you pay you, and that's it. And so for me, it's pretty exciting to be able to have control over that. And, you know, again, I'm in the early phases and hopefully I have a long way to go, but it's exciting kind of being in the middle of it, that's for sure.
So as you're making these transitions, what kind of challenges make you lose sleep at night or, you know, worry you?
So I guess none of it really worries me too much. I'm pretty analytical in general, and I have spreadsheets and I have budgets and all that.
I can attest to that.
Yeah. I mean, I'm sure it's the engineering background type thing, but like with my first property, it was that was the biggest risk I had taken, but I was really comfortable with it because I had done my research. I put it all on paper. I said, you know, worst case, if this doesn't pan out, I can sell it and I'll lose this amount of money, and that will suck, but I will, you know, I'll still be afloat. And I'm kind of looking at it the same way here. I have my budgets. There's definitely unknowns, but mitigate those as much as I can, you know, with the handyman type stuff and putting away the right reserves. So I guess things that I'm accounting for, like insurance, you know, not lack of benefits from my company that, you know, don't show up in my year-end statement, but I'll have to start paying for, you know, now by myself. And so one of the things that I actually just closed on it Wednesday, which is 2 days ago, and I closed on my HELOC on my house here in Denver. So that'll be, you know, my emergency funds / you know, investment funds on top of, you know, putting some cash aside also. And then I'm looking into getting a HELOC on my triplex also before I leave my W-2. And again, before I leave my W-2 because they're looking at that. So trying to put all dot the T or cross the T's and dot the I's before I leave my W-2 because, you know, lenders look at that quite a bit, you know, once it's gone.
You sound like you're really making good plans, and that's really awesome.
I'm trying to. I'm hoping I'm not missing anything major, but trying to do my due diligence so that transition isn't so stressful and scary, you know.
Yeah, and I believe that you have another venue for fun as well. If you've been with your W-2 for a while, you may have a sizable retirement plan with them, and you could roll that into a self-directed IRA and use that to buy real estate.
Sure. Yeah.
So that's an option that you may be worth looking in. Yeah.
Mm-hmm.
What plans do you have when you become a full-time real estate investor?
So, I mean, I have my, 10-year plans, which are a lot more grand in scale than, the next year or so. But I want to buy, I think probably 3 or 4 properties this year. So, like I said, I'd like to buy one more property here with my W-2, probably on a conventional loan, partnering with a friend of mine has a primary residence, so we can take advantage of a lower interest rate and a lower down payment. And then after that, after I leave my W-2, then I will probably either pursue seller financing projects or BRRRR projects. I should say pursue both. It's not necessarily an or. I'll probably do seller finance projects and BRRRR projects. But I want to own. I want to own buy and hold rentals.
Do you identify a market that you're going to go to, or you think you're just going to buy anywhere again?
No, I've definitely narrowed it down. I mean, Houston was kind of my jump. That was, I know, I had the Minnesota place. I won't go back to Minnesota because of the COVID stuff, and it's a blue state, and that kind of proved to really bite me in the butt. So lesson learned there. And then Denver, I think, is just too expensive, and it's probably stable, but I think buying in now, I've kind of missed the boat on that. And so I think Houston's a really good next spot. And that's kind of, I bought 2 properties there. I'm probably going to continue buying there. I've also considered San Antonio as another spot. So it's going to be Houston or San Antonio for now, and then down the road, of course, probably spread it out. But
well, the opportunity definitely is here in Houston, because as one of the people keep moving here, we're still going to have a need for real estate, right?
Mm-hmm. Exactly. Yep. And that was part of my analysis, was I found a really good tool for quantifying, and again, I like to quantify things, quantifying different markets. And Houston was right towards the top of the list as far as growth, job growth, all those types of things. So
that's why I say to people, I love to live here and invest here, because opportunity, like you can buy, there's a lot of opportunity here, and the cost of living here is fairly reasonable, and you can save and travel elsewhere.
Mm-hmm. Absolutely.
All right. So as we are wrapping up, what is something that people might be surprised to learn about you?
I played hockey through college, and I took 2 years off after high school. So between high school and college, to go play junior hockey up by Winnipeg in Canada. So you might be able to tell from the hair I've grown out recently, but that might surprise a few people.
Didn't know if you joined a rock band or something.
Yeah, right. No, I started working remote, and I really haven't cut it since. It's probably about time, but I was short hair and hair gel for several years, so I'm enjoying a little bit of freedom working remote.
I tell you, it's working remote really changed people, right? All right. So last questions. How does the audience get in touch with you?
So I'm not really on social media with any of my real estate stuff, but my LinkedIn is still set up for my job, but you can certainly reach me there. It's Steve Sorensen. It's S-E-N at the end. It always throws people off. People think it's S-O-N. Or my email is sms.investmentteam@gmail.com. That's SM as in Michael. Those are probably the 2 best ways.
If you enjoyed this episode, I highly recommend you to watch How to Become a Millionaire Through Real Estate Investing. And by the way, don't forget to hit that like and subscribe button, and we'll see you in the next video.